Hi, I'm Christine Benz from Morningstar.com. Morningstar's investor return data provide a clear depiction of investor behavior. Joining me to discuss some current research on that topic is Russ Kinnel. He's Director of Manager Research for Morningstar. Russ, thank you so much for being here.
Good to be here.
Russ, in your cover story in Morningstar Fund Investor, which is coming out in early March, you took a look at investor return data, asset class by asset class. Before we get into what the data are telling you about investor behavior, let's just talk about this investor return statistic, how we arrive at it.
Yeah, it's a little complicated. So essentially what we're doing is we are asset weighting flows in individual funds, then rolling that up and comparing those returns with the average returns of all funds. What that tells us is the gap is essentially average investor versus average fund. And so if there's a big gap, we know something's not working, we're not getting quite the right usage, or if it's a small gap, maybe people are using the funds right. So it's kind of complicated, but if you just think about it as average investor return versus average fund, it's really kind of simple in the end.
Okay, so the main idea is to tell a tale about investors' timing. How well have they made their timing decisions, their purchase and sales decisions within these various categories?
Exactly. A big gap means the timing hasn't been great. A small gap means it's been pretty good.
Okay, so let's start with domestic equity. When you look at the recent rally that we've had in domestic equity, have investors been able to capture that, or did they get to the party late?
A little of each, really. Investors coming out of the bear market in 2008 kept redeeming for a number of years in general in U.S. equity, though not on a huge scale. So what that means is they captured some of those gains, still had a pretty good overall return, but not all of them. Another element of that story is kind of subtle. It goes all the way back to the beginning of that 10-year period, which is that coming out of that bear market, people took about a year to come back to equities. But once they did so in a big way, and that helped their returns going forward. Whereas this more recent bear market, people were much more slow to dive in and therefore missed a little more of the returns.
Okay. How about international equity? It's been kind of interesting, even though we've seen really strong performance from domestic equity markets and funds, we've seen investors continue to buy international equity really all the way through this great run-up in U.S. equities.
That's right. It's kind of funny that we've seen more money going into international equity than U.S., even though the U.S. has done better. I think there's sort of an insecurity about the U.S. The 2008 bear market was pretty traumatic for everyone, not just because of the bear market, but because of the economy and all these worries about growing U.S. debt. And so people tended to focus on that rather than the returns. So they invested more overseas. And overseas markets generally did pretty well, just not as well as the U.S. So it wasn't a bad spot to be. You still did pretty nicely, just not as well.
One area that you think may be kind of dragging down the international equity investor returns is emerging markets. Let's talk about the timing pattern that we've seen there.
Yeah, a big theme of coming out of that bear market in 2008, 2009 was kind of China and a lot of the emerging markets were going to be really crushing the U.S. And to the contrary, emerging markets have actually been a pretty weak performer in the last few years, partly because of a China slowdown, but also because of a slowdown in natural resources with oil and copper and some other natural resource prices plummeting. That hits a lot of emerging market economies, particularly those in Latin America.
Okay. One area that we've been monitoring, in part because the investor returns had recently looked quite poor, has been the fixed income space. It looks as though many investors got into bonds late, even though they haven't had a terrible experience either. Mm-hmm. Their returns have not been great when you look at the timing of their purchases and sales.
That's right. The timing hasn't been that great. If you look at some of the big purchases, we've seen some big clumps into taxable land muni bonds, often when rates are at their lowest, and that then led to years like last year where in a lot of places returns were not as good as in equities. But muni bonds are maybe the most stark example. Munis, we've seen two big scares that led investors out at just the wrong time. First, there was Meredith Whitney's prediction of huge defaults, which was off by a massive amount, maybe
materialized.
Right, she said about 100 billion, and there was about a billion or so of defaults. And then we had a second scare that was a little more reality-based. Puerto Rico and Detroit had some very serious problems, but they only touched a little on the muni fund world, yet investors moved out a lot. And so what that meant is you had two waves out of muni funds, and in both cases, investors then missed some good rallies. And what's particularly disappointing there is that munis tend to have pretty boring returns, so they should have kind of stable inflows, and the returns are not that big. Obviously, you're getting after-tax returns, but they're pretty meager to begin with, and so if you time it wrong, you really can be cutting into your returns.
Okay. One more positive story when you look at the data is in the allocation fund space, the funds that split their assets among stocks and bonds. And one area in particular that looks pretty encouraging is the target date area. It looks like investors, when they've bought target date funds, have kind of tended to hold on.
Yeah, target date funds are really the shining star of these mind the gap reports. We find that investors tend to actually get better returns than the official returns in the funds. And the reason for that is that they're just continuing to invest. If you're in a target date fund, you're almost certainly in there through 401k, so you're investing every paycheck. And so we found that people really consistently invested in them. So it's really an encouraging example that here's where the fund industry and fund investors have really found a good solution. Target date funds and 401ks, to a larger part, are really working nicely.
So I guess what are the takeaways for investors? Is the idea that I should just buy a target date fund and call it a day because it will tend to encourage better investor behavior? What should investors think about when they're looking at these data?
Yeah, so I think on one hand you see here's a group of investors in target date funds who are largely ignoring all the headlines and just plugging away investing. On the other hand, you have groups that are more skittish. They're rushing into China, then they're selling their muni funds, whatever. They're doing much worse. So there's clearly a message there that instead of trying to predict macro movements, it's much better to just stick to your plan and keep plugging away. A second lesson is that dull seems to work well for investors. Target date funds are boring. They've got a really diversified mix of stocks and bonds, U.S. and foreign, and so the returns tend to be more muted. And that seems to work. So one approach could be think about your overall portfolio and ignore the fact that one of your funds is up 30% and another's down 20%. Or if that doesn't work for you, maybe just buy either a target date fund or a boring old balance fund, which has a lot of the similar characteristics of muting extremes.
Okay, Russ, thank you so much for being here to share this data. Fascinating stuff as always.
You're welcome.
Thanks for watching. I'm Christine Benz for Morningstar.com.